Internal Revenue Service IRS tax news. Here's what taxpayers can do now to get ready to file taxes in 2021. COVID Tax Tip 2020-159, November 23rd, 2020. There are steps people can take now to make sure their tax filing experience goes smoothly in 2021. There's a link to tax filing here as well. First, they can visit Get Ready page on IRS.gov. There's a link to the Get Ready page here as well. Here are a few things people can do now. Check their withholding and make any adjustments soon. Since most taxpayers typically only have a few pay dates left this year, checking their withholding soon is especially important. It's even more important for those who receive a smaller refund than expected after filing their 2019 taxes this year, owed an unexpected tax bill last year, experienced personal or financial changes that might change their tax liability. So that's probably a lot more people than usual in 2020 who have some kind of changes that may affect the amount of withholdings that they need. So traditionally, withholdings, when we had withholdings, if you were a W-2 employee, you filled out your W-4 and that basically took care of the withholdings, and the withholdings were designed to kind of overshoot a little bit so that you're going to be able to get a refund, at the end of the day or at tax filing time. However, due to the current condition as well as just the normal conditions going forward, it's quite likely that more people are having more than one job. For example, you might be working more than one jobs, or one family, of course, could have people working in it. Husband and wife could be working. You got multiple people filing on one tax return who have more than one job, and that makes it more difficult to calculate the withholdings for the family, for the return that's going to be filed. If you're filing a joint return, makes it more confusing to file a joint return and know what the withholdings should be. And then, of course, if things change from year to year, that makes it more difficult as well. So in other words, many people are kind of dependent on their prior year tax return to determine what their withholdings should be in the current year. And that means that if you're dependent on the prior year tax return, you're usually thinking that the prior year is going to be somewhat similar to the current year. If there's substantial change in the current year compared to the prior year, then you might want to take a look at your withholdings. The goal of looking at the withholdings is to avoid penalties and interest, not necessarily to get a refund. That's not really the goal. The goal is to not be paying more taxes than you would otherwise be paying by having to pay late payment penalties and possibly late payment penalties in this case. So you basically need an estimator typically to do that. You need to do some kind of estimate to make sure that you're making the proper amount of payments throughout the year so that you have it covered, so that when you file at the end of the year, the goal really is that you don't owe any money and you don't get any money back. You paid it perfectly. But that's not typically the case. You can't do it. It's too complex. So we typically try to overshoot, not so that we get a refund at the tax filing time, but so that we can make sure that we avoid having to pay penalties and interest. So the IRS has a tool to kind of help with that, which is pretty good, Tax Estimator. Now it's the end of the year, of course, at this point in time. So if you use the tool and you find that you're short on the withholdings, you've only got a couple payments possibly left if you're withholding from a W-2 employee type of situation, to increase the withholdings, for that amount of time to try to cover the amount of tax that will be due, and again, in order to avoid the penalties and interest. If you do that, then you probably want to adjust the withholdings at the end of this year and then adjust them again at the beginning of next year so you can bring them back down to the level they need to be at to be able to be proper to cover the entire year. So many people will base their withholdings again based on the 2019 tax return or the prior year tax return, but a lot of people in 2019 returns probably didn't file them till later and may have been put on extension as well, given the extended due date of the original return and then just the issues that have taken place. So you might not have had as much time to determine what happened last year compared to this year with the 2019 return. Also, of course, again, if there's any big changes in the tax return, you might want to take a look at the withholding again, and that would be, again, changes in the job status. So if you're working different jobs or multiple jobs, that can have an impact. If there's a change in kind of dependent level, if there's a marriage or something like that, or divorce or something like that, then you're going to want to take a look at those kind of conditions as well. Back to the text. Some people may owe an unexpected tax bill when they file their 2020 tax return next year if they don't have enough withholding withheld throughout the year. To avoid this kind of surprise, taxpayers should use the Tax Withholding Estimator. There's a link to the Tax Withholding Estimator here to perform a quick paycheck or pension income checkup. So you can do a paycheck or pension income checkup. Doing so helps them decide if they need to adjust their withholding or make estimated or additional tax payments now. So then that'll help you to determine whether you want to make additional payments. And you could do so either by filing a W-4 with your employer to increase the withholdings. If you're able to do that, that might be the better way to go, because if you withhold the money, then the IRS kind of assumes typically that the withholding took place throughout the entire year, even though you kind of did the withholdings at the end of the year. But if that's not enough and you have to make payments, you can make the payment and still avoid some possible penalties and interest. But then the IRS is more likely to say, hey, you paid that in the fourth quarter and we want our money kind of evenly throughout the year. And so you still could likely have penalties or interest based on paying it kind of late at that point in time. Whereas if it's a withholding, the IRS kind of determines or usually kind of assumes that the withholdings were even throughout the year. But in any case, back to the text. Gather tax documents and keep them for at least 3 years. Everyone should come up with a record-keeping system. Whether it's electronic or paper, they should use a system to keep all important information in one place. Having all needed documents on hand before they prepare their tax helps them file a complete and accurate tax return. This includes their 2019 tax return, so you want to have the prior tax return. That's always kind of the starting base when preparing a tax return. Form W-2 for the employers, Form 1099 from banks and other payers, Form 1095A from the marketplace for those claiming the premium tax credit, Form 1099 NEC, non-employee compensation notice 1444 for economic impact payment. Most income is taxable, including unemployment compensation, refund interest, and income from the gig economy and virtual currencies. So that's kind of the default position in the IRS tax code. So if you're getting something, if you get money or not money, or if you get anything, the IRS basically assumes it's income unless it's on the categories that say it's not income, right? So the default assumption to the IRS is, well, you got something, it's either income unless we list it otherwise as falling into one of these categories that say it's not income, and therefore you'd pay taxes on it. And that will, of course, include gig economy, which the IRS is more and more concerned about because they're having a little bit more trouble tracking the income on that one. So gig economy and virtual currencies is another one that's kind of concerning the IRS to make sure that they get their cut of the income and whatnot. So therefore, taxpayers should also gather any documents from these types of earnings. People should keep copies of tax returns and all supporting documents for at least 3 years. Confirm mailing, and just remember that the IRS could audit you within that 3-year period. That's typically the statute of limitations, and they could even extend that in certain circumstances. Therefore, you want to make sure you put the tax return together in such a way that it's not like if you get your refund, people often think if they get their refund, it's over and there's no, there's no chance that you'll ever have to deal with this tax return again. That's not the case, because they're going to process the refund and they still have up to 3 years to see if there's a problem with it, or simply just randomly pick an audit time for it. And again, if there's a substantial problem, they could even go more than that. But typically the statute is 3 years. So you want to make sure that you have the documentation such that if you looked at it 3 years from now, then you'd be able to figure out kind of what happened, or someone else even looked at it 3 years from now, they can figure out from what happens. And I almost think like the states, like I live in California, and the S corporation returns and whatnot, it almost seems like they purposely wait till the end of 3 years to then say, hey, you owe us some minimum amount or something, because then they charge interest and penalties on it at the end of that time period. So they might, it kind of feels like they wait on purpose sometimes and then charge you interest and penalties like later that have accumulated. But in any case, you want to hold on to the documentation for that time period. So confirm mailing and email address. To make sure forms make it to the taxpayer on time, people should confirm now that each employer, bank, and other payer has the taxpayer's current mailing address or email address. Typically, forms start arriving by mail or are available online in January. Remember, these new things when preparing for 2021 tax filing season. Taxpayers may be able to claim the recovery rebate credit if they meet the eligibility requirements in 2020 and one of the following applies to them. So this has to do with the economic impact payment. So the economic impact payment kind of ties to 2020 return that's going to be calculated in 2021. If there's any problem with the economic impact payment that went out, then they're going to kind of take care of that with the recovery rebate credit. So here's how it goes. So in 2020, and one of the following applies to them. They didn't receive an economic impact payment in 2020. So if you didn't get an economic impact payment and you're like, I should have got one, then you might be able to take care of it at this point in time when filing the 2020 tax return with the recovery rebate credit. They are single and their payment was less than $1,200. So if you got a payment less than $1,200, that seems rare. I'm not sure exactly how the IRS would have done that. But if you got a payment less than $1,200, possibly if there was an income phase out, then maybe they got that. But in any case, they are married filing jointly for 2019 or 2018, and their payment was less than $2,400. So similar situation with a married return. They didn't receive the $500 for each qualifying child. And this is the one the IRS has kind of been going after for a while. So if you only got the $1,200 if single or the $2,400 if married and you had qualifying children that they didn't pick up, then possibly you can pick them up, getting that extra $500 per qualifying child in the 2020 filing of the tax return, which would happen in 2021. Taxpayers who receive a federal tax refund in 2020 may have been paid interest. The IRS sent interest payments to individual taxpayers who timely filed their 2019 federal income tax returns and received refunds. So the IRS is basically saying all interest is still taxable. So even though the IRS is the one that paid you the interest, and this is pretty minimal. I mean, usually the interest that went out was like below $20, so it's not like it's going to be a big impact. But they're basically saying any interest is taxable. So in this case, because of the extension of the deadlines and whatnot, many people got interest from the IRS, and you're supposed to report the interest, which again, I would think would be pretty small for most people. Should still be reported, however, on the tax return in 2020, just as any interest income would typically be. Like if it was from a bank or something like that, the IRS sees this as basically a kind of a loan in the same sense that you loaned them money, in essence, right? And they paid you interest on it, and so that's taxable. So you got to include it. So most interest payments were received separately from tax refunds. Interest payments are taxable and must be reported on 2020 federal income tax returns. In January 2021, the IRS will send a Form 1099 INT interest income. So you're going to get a 1099 from the IRS saying, hey, you got this interest income from us, and you got to include it in interest income, just like if you got a 1099 interest from the bank. So you're going to include that to anyone who received interest totaling at least $10. So anything over that $10, you're going to get one from the IRS.